So you're watching this video wondering how your VA loan could have been denied, or you're getting ready to start the VA loan process and you're trying to do everything that you can to make sure your loan does not get denied. So in this video, I'm going to break down the top 3 most common reasons why VA loans get denied in today's market. So that way you don't find yourself going through this very same hurdle. All right, so the first reason is going to involve your credit, but within this reason, there could actually be many different things that cause them to deny you. Credit could just be the overall general bucket that caused the denial. One of the main reasons is going to be credit score. Depending on the lender that you're working with, they are going to have a minimum credit score required. But the thing you need to understand is the VA technically does not have a minimum credit score. So now you're wondering, well, you said the lender has one, but the VA doesn't. Here's why. Lenders do loans, but VA guarantees the loan, which means VA determines who can or cannot get a VA loan. And then they will create their own rules and regulations that lenders must follow. But here's the thing, lenders have the ability to make the VA's rules more strict. They cannot make them weaker, they can make them stronger. And the reason for that is because the lender is the one putting themselves on the hook by loaning you that money. So if they want to say you need to have a specific credit score involved in order to get a loan from them, you need to understand that that's that particular lender's minimum credit score requirement. A possible solution to your problem, if you were told that is only about your credit score, is simply just getting a second opinion, talking to another lender that maybe doesn't have as strict of a minimum credit score requirement. For example, one of the most common lenders out there that most veterans like going to, they show up a lot of times first on Google. You can do your own research if you want. They have a minimum credit score of 620, along with other overlays as well. But me and my team can go as low as 580. So there's an example right there as to how much you can actually see a different experience with regards to being approved or denied, depending on the lender that you're working with, specifically around credit score. The next one within credit issues is also going to be around having late payments showing up on your credit report. And these late payments could be for different reasons. One, you could have late payments that are just showing up in a recent time period for things like your consumer debt. Maybe you don't have the best credit score already, but then you're also showing that you haven't been making on-time payments for your monthly liability. Sure, your score maybe will meet the lender's minimum requirement, but just because it meets the minimum requirement doesn't mean the lender has to approve you. That just means that you have met the minimum standard to be able to be approved. They're still going to look at other things in regards to your credit, like your payment history, to make sure that you're able to pay your bills on time. The last thing that they want to do is loan money to somebody that is currently in a financial situation where they're maybe having or experiencing a financial hardship. This creates a bigger risk threshold, which maybe means that they're only just going to make your financial situation worse than it already is. So if you have recent late payments showing up on your credit report, this could be one of the reasons why you got denied. Another one is going to be late payments for an existing mortgage that you either have or recently paid off because you maybe sold a property. For example, if you own a property right now and your intention is to buy another property, whether that's the prior property was with a VA loan or not, the lender is going to look at your payment history showing up on your credit report for specifically the mortgage, because this is going to give them a telltale sign of how well you are going to pay the new mortgage that you're going to take out. And if the lender sees that you have mortgage lates within the last 12 months on your mortgage payment, that's pretty much a guaranteed way to get your loan denied, even if it was just one late and even if your credit score is over 700. Now, what are some solutions to all of these problems? Well, depending on what your issue was that caused you to be denied, if it's specifically around payment history, what I would tell you to do is first start making your payments on time, but then next, I would say give yourself a seasoning period to be able to start seeing those late payments actually get pushed further back. For example, if you had late payments just 3 months ago, I would try to make sure that you're going to make at least on-time payments for 12 months or more to give yourself a little bit more of a better look to be able to get approved and not have the credit issues be something that holds you back. The next major reason why I see somebody get denied is going to be debt to income or residual income. Debt to income and residual income are two completely different things, but lenders do use these as factors to determine your ability to qualify. Going back to what I talked about earlier around the VA guidelines and how they have those rules in place, technically in the VA guidelines, there is no debt to income ratio that will make the final decision, but the lender has the ability to do that, just like we talked about with credit score. So when it comes to debt to income ratio, this is also going to depend on the lender that you're working with to determine whether or not they're going to actually loan you the money. But the biggest thing that you need to be able to meet, no matter what lender that you're working with, is going to be the residual residual income requirement. And the residual income requirement is dependent upon a couple of different things. First, it is depending on where you are located geographically. There are 4 regions. And then the second is it's going to depend on your household size. So depending on what your household size is and what region that you're in, the VA says you need to have a certain amount of money left over after all of your bills are paid. Some lenders are going to use residual income as the final decision, kind of like me and my team. And then some other lenders maybe don't just use residual income. Maybe they have a more strict debt to income ratio, which means they expect you to have more money left over. When you're trying to qualify for a mortgage, they're not just going to look at your income against your existing monthly liabilities, but they're going to also factor in your new monthly mortgage payment within that to make sure that it is able to meet the residual income requirement. The next major reason is going to be around your income and employment history. Now, if you're pretty much a W-2 employee, salary, hourly, those types of incomes, they're pretty basic and pretty easy to accept. But within these buckets where you can find yourself get denied is maybe you had job gaps. You had a lot of time off between working from one employer to the next employer, which means that your employment looks very unstable. Maybe you've transitioned from being a W-2 wage earner to being 1099, which is common. One particular career field I can use as a good example of seeing this is with truck drivers. There's a lot of truck drivers that I've seen go from W-2 to being 1099. Now, sure, they make more money, but the difference is that 1099 income is not necessarily guaranteed because you're more of a contractor. You're not actually like a guaranteed employee. You may be making more money, but here's where the problem is. Whenever you are receiving 1099 income or you're receiving commission or any type of bonus income, this income requires at least a 2-year history to be able to be accepted. Even though you maybe have been in the industry as a W-2 wage earner for 10 years and then you just switched to 1099 income, we can't use that 10-year history because you have not been 1099 for 10 years. You have to have been 1099 for at least 2 years or more to be able to have that income be factored in. Some other things to keep in mind is maybe your job is a remote position, but it's not fully detailed on paper. You see, for example, the lender is going to reach out to your current employer to do what's called a verification of employment. And if the status of your employment is not consistent with what you're telling the lender, this can also get your loan denied. I've seen situations where people are moving from one state to the next because they are a remote employee and they're expecting their employer to allow them to make that move, but they're not actually telling the employer that they're making the move. Like if that employer is in, Texas and you're telling your employer, hey, I'm going to move from Texas to California because I'm remote. If they don't have on paper within their HR department that you are truly remote, when they do that verification of employment, they may not put down that you're remote. There are some times where I've seen situations where people are like semi-remote. The verification of employment is a major part of the qualifying process that you need to make sure you can actually meet. The lender is not just going to take your word for it. They are going to check with your employer. And the last major reason I've seen VA loans get denied is going to actually be the property. The VA has a specific chapter in their handbook called minimum property requirements. And it's extremely important that the real estate agent that you are working with to help you find property understands that chapter, because guess whose time they're wasting if they don't? They're wasting your time. The VA's minimum property requirements clearly outline exactly what the property must be able to meet in order for you to get a VA loan. And this can end up causing you to get under contract for a property that you really love, but then the lender can't close on it. And it's not the lender's fault. The lender is simply just trying to meet whatever VA's minimum property requirements are before they'll actually loan you that money. So this is also where I'm going to preface the importance of working with a VA knowledgeable realtor. If you want to get connected with a VA knowledgeable realtor in your market, let me know. I have a network of 18,000 real estate agents nationwide that are knowledgeable and understand the VA home loan benefit. I can get you connected with somebody that's going to look out for your best interest. So there you have it, my top reasons for why VA loans get denied. If you got value from this video, do me a favor, hit the like button down below and let me know down in the comments if there's something that I missed or something a lender told you that you want to get a second opinion on. The last thing I'll leave you with, which is the most important thing, Jesus loves you and he paid the ultimate price for your life. So if you turn to him, trust in him, and believe in him, he has a beautiful plan and purpose for you. I'll see you in the next one.